Hi, everybody. I'm Diane Brady. I'm here with Sean Kevlin, who is the CEO of the Insurance Information Institute. Sean, good to see you on another smoky day here in New York. Let's talk about the insurance view on what's happening. This is not the first wildfire the U.S. has experienced. What kind of economic cost do these events bring us?
Well, certainly from an insurance standpoint, we measure ourselves by the loss implications of catastrophes, most of which are related to natural catastrophes. And if you go back to the 80s, the loss cost average has increased about 700% since
Wow.
the 80s.
From wildfire damage alone?
No, not just wildfires. You got wildfires, hurricanes, convective storms.
Right.
Those types are all put into that loss cost number. And, that arguably shows that, there is increased climate risk. It also shows that the insurance industry has been dealing with it for a long time as it's been seeing it. But we are seeing it become closer and closer to our time now. In fact, 9 of the top 10 record loss years for the industry have happened since the 2000s, with the other being in 1996 when we had Hurricane Andrew. There's a couple reasons for that. There's an evolution, obviously, in kind of the climate area and how the risk is, but there's also a sense where more and more people are living in harm's way.
Yeah.
And so in wildfires case, for example, you used to see wildfires really not do an extensive amount of damage to human property, if you will. But now, as we've been developing and building more and more in harm's way, I recently did an interview where the reporter who grew up in Southern California was explaining that, the hills behind their house, they used to see wildfires, but now they also see homes.
Right.
Or South Florida is now one of the most growing populations in the country.
At the same time, go ahead. At the same time,
that gives you an illustration just of there's more and more people living in harm's way as we're seeing an evolution in climate related risk, and then you've got some other human related elements that work into there, and all of that is increasing the risk. And when you increase the risk, it also increases the price of that risk transfer tool called insurance. And so there we're beginning to see, states that have individual characteristics where we're in some places getting into a crisis around property and the affordability and availability of insurance.
Well, we've seen in Arizona, for example, restrictions on future building around Phoenix. That's for water reasons, I believe, more so. But climate, perhaps, obviously plays into that. We do talk about it on a state-by-state level. I want to get back to the wildfires a second, because the example you cited was of a home burning in the state where the wildfires are taking place. And, that's a very direct causal link we talk about. We talk about the health impact. What about impacts like, for example, having to shut down a business? Is that covered by insurance typically if it's so smoky that I have to cancel my event? Is that typically insurable?
Well, typically, with a property insurance policy, if you have physical damage to that property, it will trigger a property insurance claim. So in the case of smoke, it has to be proven whether or not there was actual physical damage to the property as a result of that smoke. So those are individual circumstances, right, depending on where you're at and how much smoke intake you did have. I actually experienced a home fire as a child, and a lot of the insurance claim covered just the smoke damage from the house, even though the fire was relatively low. But the other part of it then is, does the business have a business interruption policy, which is a separate part of a business policy that they have to opt into, right? So insurance does play a role in wildfire and the risks associated with it. And typically, especially if you're directly impacted by a wildfire, like the ones we're seeing in California, and your home is damaged and you have insurance. But what we also need to consider as well is just making sure you have enough insurance too. another factor that's happening right now in the insurance industry related to inflation is the very high costs associated with the likes of construction materials.
Yeah.
We've done analysis where if you look at the cumulative compounding of year-over-year inflation for the last 3 years, homeowners-related replacement costs have increased 55%. So when
Have
you have
policy
that high
rates
cost,
increased?
you also want to make sure that the insurance matches it. I'm sorry?
Are more people underinsured now as a result?
We definitely think there could be an issue where people aren't necessarily paying attention to to inflation as it relates to their policy. The insurance company, though, is. You will find that, for example, if you own a home and you have an escrow account, you might be receiving a notice that there needs to be more money going into that escrow account because the amount of insurance is more expensive. So, but it does warrant, we always advise people to call an insurance professional at times like this to make sure you've got the right amount and type of insurance.
Let me ask about the states, because insurance is really a state-by-state issue and regulation. And very recently, State Farm exited the state of California, one factor being, climate change and wildfires. But talk about the idiosyncrasies of different markets, starting perhaps with California.
Yeah, absolutely. So it's, there are things that factor into this equation that every state has. We've talked here today about inflation. We've talked here about increased climate risk. We've also, but in the case of the likes of California, we also have, what I would characterize as a bit of an antiquated public policy area that happened in the 1980s. It was called Proposition 103. And basically, I think it was well intended. However, given the circumstances of today, it probably doesn't apply to today's market and situation. For example, it actually, one of the areas it bars insurers from pricing prospectively based on climate models. So you have to look back on your underwriting and pricing of costs. You can't look forward. And in today's insurance market, forward-looking modeling is a part of everyday pricing.
So you can't use predictive AI, basically. That it's almost ironic that one of the biggest centers for development of AI, insurers are unable to use it for predictive modeling there.
There is some information and communication that's going on right now to get the regulatory world comfortable with insurers and AI in some forms and fashion. There certainly is a benefit to it, but I think we're also seeing a broader conversation of making sure that that there aren't unintended consequences. And the industry, if members, carriers in the industry, along with the regulators, are in discussions to figure that out and what makes most sense. However, putting even AI aside, we have predictive modeling that has been being used for many years in the industry. Yep. And it's been very effective. But in the state of California, you can't price that or use that as a pricing tool. The proposition also restricts using reinsurance, applying the reinsurance costs into the price of
That's
the
insurers of the insurers, basically.
That's right. It's just another way for the insurance company to do what insurance does, is spread risk, right? So that we can cover it if and when things happen. The third part that I'll also just mention about this proposition, because it matters, especially as it relates to the inflation time we're in, is it actually restricts the amount of insurance rate increases that you can have in the approval process. So, it limits when you do have that very high inflation and the materials are more expensive. By law in California, you're not allowed to price the risk according to what it is if you've got this inflationary environment. So those three things really make California a bit unique and restrictive when it comes to property insurance. And this industry, insurance, is really designed to be stable and sustainable. So if you take on too much risk that you might not be able to cover, that's just not how insurance works. We, as an industry right now, we've got about $1 trillion of what we call policyholder surplus on hand, so that we can pay the claims, when they come, and we're increasing that policyholder surplus with regulators because we're seeing all of those increased risks I talked about. But if you can't do that in certain areas, it's going to restrict a company's ability to underwrite effectively. And I think that's in large part why you're seeing the withdrawals like we are.
On a macro level, I've seen Stanford statistics. I think it was, 125 billion a year in economic costs between 2007 and 2019. That was from wildfires alone. I remember in Florida when AIG, tried to pull out after Hurricane Andrew, saying that there are certain places that are just uninsurable. How much of a reality is that now, as we've seen climate change take an especially heavy toll in some areas, that insurers just don't want to touch it, that there's no private sector solution? Is that a danger?
Well, what's interesting about the state of Florida is that since Andrew, the state has done quite a bit progressively to prepare itself and to become more resilient, including building codes. They have some of the best building codes in the country, and as a result, that allows it to better withstand the impacts of hurricane. However, that's a slow pace that it takes to get those. That means all new homes and building codes and all rebuilding, right? So we still have obviously a lot of historically old buildings in the state. That said, with that progress, what's more than offset the ability for insurers to do business in Florida is from legal system abuse. So just to give you some statistics of what's happening in the state, and they have passed reform. They just passed some reform on this, but prior to this reform, actually still exists. It's probably more so after I tell you some of these statistics. 79% of overall homeowners litigation for the whole country resides in the state of Florida. So nearly 80% resides. Now, the state itself represents about 9% of the overall claims, right? So, and on average, every year on average, the state of Florida has about 100,000 homeowners litigation cases put into the system. I mentioned that reform earlier.
No, litigation for what? Litigation saying that they're not getting sufficient insurance for the damage they've incurred? What is the litigation around?
The litigation is in large part spurred from some unique circumstances that Florida was allowing. One of them was called assignment of benefits. Basically, what it did was allow a claimant, a consumer, and usually they were prompted to do this, to sign their claim off to an attorney or a contractor. And that allowed the contractor and the attorney to then negotiate the claim. And if
like
the
a
claim
debt collector
was in any way denied, it would go to litigation, right? And then the litigation would spread out, and these costs, become significant. But the legal environment, because it had the likes of assignment benefits, we would call legalized fraud, because it's just designed to inflate claims. Right. So thankfully they've actually put reforms forth this year to not have the assignment of benefits, not have one-way attorney fees present in the state. However, in the 3 days, 72 hours from when the reform was passed by the legislature, and then 3 days later signed by the governor, we saw 280,000 cases filed in the state.
Wow.
So you've got reform, which people want and need. I mean, insurance is actually, we understand in Florida, topic of cocktail parties. Right?
Yep.
That's not something to hear all the time, but it's because it's very expensive and it's hard to find. And it's been hard to do business in that state as a result of this legal system abuse, not what you were talking about being a hurricane prone state.
Right.
I think as much as that's a risk, I think that Florida is getting itself more prepared.
It's a bigger tort risk. Let me finish by cycling it back to where we are today. The source of our pain at the moment is coming from Canada. Increasingly, these are cross-border issues. And often when I think of insurance, if there's any sort of recourse, you try to go to the original source that causes the damage. How is the global nature of these challenges impacting your industry, if at all?
Well, it's certainly, the global nature of catastrophe, the increasing in economic losses is not limited to the United States. Absolutely.
Of course, yeah.
And so it is obviously a global problem. The United States represents more than 40% of the overall insurance market. There's proven evidence that shows a more insured economy has higher GDP per capita. Correct? But it is global risk, and you do see insurers needing to spread that risk out more globally, because with the exception of the likes of a pandemic, these risks aren't happening all at the same time,
Yep.
and so that the industry is working hard to make sure that its risks are spread. And again, going back to California, some companies saw that their risk was simply too high, and just located in one particular area. And when you have that can bring negative consequences in a way that the insurance industry just doesn't want to have happen. So that's why you're seeing that risk, and they'll probably go to have that risk transfer in other areas then.
It seems inevitable that the costs are only going to go up, Sean, in the environment we're in. So thank you for joining us. I don't know if there's anything else you'd want to say in terms of what's on your radar in this area that you think should be on ours.
I think one important thing to consider here is there's a shift happening, and the insurance industry is focused on this, from simply detecting and repairing after something happens to predicting and preventing. Mm-hmm. And really that's where we need to come together as a community, a collective responsibility, and determine what's the best way to make communities more resilient. Because mm-hmm. the price of insurance is the effect, not the cause. So we've got to look at what the effect is, and we've got to find ways, in particular around our physical infrastructure, to make it more resilient so that we can live and manage our risks in the evolving climate risks that we're seeing. Risks are evolving. We're living in a riskier world, but I think we got to understand, well, why is that happening, and what can we do so that we can predict it more and we can prevent it? I think that's going to be a real critical part of our future.
Great. Thank you for joining us, and I look forward to continuing the conversation.
Thanks so much. Appreciate it.